Hi there, my name is Kent Skornia, President and CEO of Krilogy, and this is my partner John McArthur, Chief Investment Officer here at Krilogy, and this is your December market perspective and update. Johnny, what a year, huh? I mean, it's been a pretty incredible ride.
Sure has.
S&P down 20 plus,
Once
depending
again,
on the day, right?
Once again, yep.
Yeah. The bond market actually is probably the thing that is a little bit unique in a year like this, minus 13, 14%.
Yeah.
Just for the rate hikes. We're going to do a couple of things today. Number one, we're going to talk about 2022, kind of do a quick recap, but also look forward into what 2023 looks like. John, give us some thoughts, perspectives on 2022.
Yeah, 2022, high level. As you alluded to, the stock and bond market have sold off really hard. S&P is down roughly 20% today. Year to date, we were as low as 28% from peak to trough levels, which the local bottom for the moment is October 13th, and that marked about almost 28%.
Yep.
Bond market's down about 13% year to date. It's recovered a little bit. I think for perspective, my gosh, we saw a 40-year high print in CPI at 9.1%, currently 7.1. So it is rolling over, not as fast as we would hope and want, but it is happening. We've lost over 30 trillion in global market cap year to date in equities. Incredible.
Yeah.
Cryptocurrency markets have lost a couple trillion, from 3 trillion to 1 trillion.
Right.
The 30-year government bond has declined 35%, which is the largest decline in the last 100 years. In our 60-40, or not our, but the 60-40 portfolio, benchmark 60% S&P, 40% aggregate bond market index, is down roughly 16% year to date. It's been a little bit worse than that, which is
a huge number.
Really painful for a lot of investors.
Yep.
So it's, up and down the board, it's been really, really difficult for investors to withstand. Not many places to hide, as we've talked about in prior conversations. The alternative space in general has been pretty strong to help weather some of that, but for most investors that are invested in traditional capital markets, it's been tough.
Very tough, very difficult, and also what's interesting is, we've had a lot of clients, business owners, entrepreneurs sell their companies this year.
Yeah.
Really over the last couple
of years, yeah.
Sitting on a lot of liquidity, and even sort of finding the opportunity to dance and dip their way into the market has been challenging just because of the volatility in the market.
Without question, and I think from a human behavior perspective, and we've seen this a lot recently, the desire to just grab and capture the short portion of the yield curve as interest rates have gone up so much.
Yeah.
The tendency is to just sit and park in 6-month CD or Treasury, 1-year CD, Treasury, or maybe a little bit longer. And the risk, of course, is that as time moves on, recession conditions may be set in 2023, which is our base case at this point, although of the mild variety, hopefully. The risk is to not benefit from what will ultimately happen in interest rates, which is a decline. So, bonds, for the first time in a long time, actually do offer a total return proposition. And
completely different than the last 15, 20 years. Without
a doubt.
Yeah,
We've been declining interest rates for so long. Now the bond market's moved pretty nicely here over the last couple weeks, so levels and timing is an important consideration of how to think about it. But the tendency, again, from a behavioral perspective, is just to grab what's in front of you, which is attractive short-term rates. And yes, that makes sense in part, but it's a bigger picture than that as well.
Well, if you're looking at the CPI being at 7, right, and you got $1 million in the bank, that $1 million a year ago is now worth $930. Really.
Right.
I mean, that's the thing you have to consider and worry about when you're sitting on that much cash. And that's a really difficult sort of mindset to have.
It is, and taking the long view, right?
That's exactly
understanding that the constructed portfolio is designed to supplement income in retirement and last for future generations, et cetera. So there's big picture.
Sorry, I went off on a little side road there, but let's talk about 2023. I like the way you said this. Let's break it into chunks. The Fed and their policy, the economy, and earnings. What about the Fed at this point? Are you considering for 2023?
Well, we've seen, it's really interesting to look at December of last year. There was a Bank of America fund manager survey. In December of 2021, the consensus expectation was 2 rate hikes this year. 2. We've seen 7,
right,
and 425 basis points within those 7. So obviously the data and the evidence of inflation has shifted significantly. Without question, there are stickier portions of inflation, meaning that the services segment of the economy, wage growth, so there's a more persistent nature to it. It's absolutely declining. We're seeing manufacturing data, retail sales, industrial production, you name it, economic weakness is happening. And I think from the Fed's perspective, they have the inflation dragon to slay, and they're not going to come up short.
Yeah.
They're very aware of what happened in the 70s, which they fought it partially, and then it came back a year or two later. And Chairman Powell has been outspoken about not letting that happen.
Right.
So,
because you could argue they're winning now.
Absolutely.
They're winning the fight, but the fight's not over.
The fight's not over. That's right. So that could lead to them almost being done from a hike perspective. They meet again in February. It's reasonable to expect, as they've recently communicated, that we'll see another hike. Maybe that's it. Yep. But that rates could stay higher for longer. I think what's important to remember, though, from a Fed perspective, is that it does not behoove them to give the market any inkling of easing.
Right.
That just creates easy financial conditions, lower rates, weaker U.S. dollar, stronger stock market is not a recipe of what the Fed wants in its effort to basically bring supply and demand in greater sync. We're seeing some of that through supply chains and so forth, but they need to fight the demand side.
That old saying, never fight the Fed.
Never fight the Fed, right.
We're living it right now.
Right.
So, okay, economy.
One quick thing I would add is if we can trust, getting out of the noise of all the Fed commentary, if we can trust that the weakening economic conditions that we're starting to see will continue to not only occur but intensify more than likely as the rate hikes continue to show up in the system.
Yeah.
Housing and employment are typically lagging indicators. If that continues to happen, the Fed is unlikely going to turn a blind eye on that, and they'll have some justification for pause and reassessing is the hopeful case.
Yeah, because they're threading this needle of slowing everything down, but not creating such collateral damage that it starts to ruin.
That's right.
The economy, and it put us in a deep recession.
That's right.
So okay, further on the economy and recession thoughts there?
Yeah, there's plenty of evidence, particularly from a historical perspective. If we look at leading economic indicators, we look at yield curve inversions on really all segments of the yield curve. The 3-month Treasury relative to the 10-year Treasury has been over 80 basis points. That's a significant inversion, a much more accurate tell than the 2-year, 10-year measure in terms of an impending recession. It's important to remember that it's a terrible timing tool. It often precedes a recession. That inversion level is worse than what we saw in the financial crisis in the tech bubble era.
Yeah.
So, you kind of marry that with rate of change in unemployment, which we're starting to see. So the evidence is there that it's likely to see a 2023 recession in technical terms. But as we've also talked about, confusing that too much with what that means for the market is not a great takeaway, because the market
could be 6 months ahead of the economy in terms of what's happening.
That's right.
And you could technically be or have been in a recession, and the market take off on you. You lose opportunity.
That's right. No one rings the bell.
We've seen it many times in our career.
Right. And so the uniqueness of inverted yield curves, not only domestically but globally, central banks across the globe are raising rates. The ECB and the BOE just did 50 basis points each, and
you could argue that they're behind us.
That's right.
Yeah.
Inflation is arguably worse there, which is actually a case for a weaker U.S. dollar in time. in 2023, which would help risk assets in general, generally speaking, in theory as well. So, yeah.
From my perspective, I think the thing we want to worry about most next year is earnings. If earnings deteriorate, that's a big tale to what's going to happen. What's your thoughts?
Yeah, so earnings in market. There's a lot of consensus thinking in not only market price level forecasting, which is extraordinarily difficult and historically really hard to do.
Right.
But there's a lot of consensus thinking in terms of what has to happen to earnings going forward. And we acknowledge that they are softening. They have, certainly excluding energy, they've come down quite a bit. They'll continue to come down quite a bit. But from our perspective, it's really important to remember the financial health of households in general, as well as corporations coming into this period. I mean, we had a due diligence call this morning and highlighting the banks and capital ratios at 13.5% compared to 07 at 4.2%.
Right.
So
they're sitting on so much more cash.
It's a different, it's a different era, and so the ability to, from an earnings perspective, to withstand certainly what we think is an outcome of a really harsh recession. We just don't see it at this point. Yes, if the Fed continues to jam on the monetary brakes and completely turns a blind eye to softening economic conditions, which is continuing to show up, then there's risk. If we look at 2022, corporate earnings will come in about $223, give or take. It's conceivable for earnings to be flat next year. Now, that might be a stretch. They'll likely soften, continue to soften, and then maybe rebound, hopefully, as the year goes long in 2023. But, if we look at the past 25 years, earnings forecast at beginning of year to end of year, there's typically a 7% variance in either direction. So naturally, with recessionary talk, if we assume the worst, and if we get a 7% drawdown from current earnings expectations, which, by the way, for the present moment, consensus is still around 230. So slight earnings growth, even at this moment, that puts us at 207, 210 in corporate earnings for 2023. We start to put, prices on that, multiples on that. We've seen 3,500 in the S&P. 3,500 over 207 or 210 gets us at a 17 PE where we've been. So, I don't know. Obviously, no one knows where the market has to ultimately end up.
Obviously, not a bullish case at the moment, right? But not anything to sort of worry about some sort of major crash, that we potentially could see.
That's right. And Jamie Setley, our director of technical research, says, look, when everyone is calling for worst case or a horrific bear market or a crash, that's when it doesn't happen, when it's consensus type of feeling. And so, we acknowledge that, the lows may or may not be in. We just don't see material weakness beyond where we've been at 3490 for the lows on the S&P at this point.
What gets us into, it's not easy street out there. Finding returns is difficult. Protecting your investments is also difficult. Portfolio-wise, what are you recommending to our wealth advisors and then therefore our clients out there?
I would say if you've got a process in place for portfolio construction, just stay disciplined to it. It's good to ask questions and understand kind of the why, what, and how a portfolio is constructed, but trusting that process is important. Emotional decision making is never successful in investing. That's one thing. I think the second thing I would say, and we've talked about this thematically, is look globally. It's so counterintuitive because of what international investing has been since 2009. The U.S. has handily outperformed, but again, we're in a different area on a go forward for a number of reasons, and so I think it's smart.
And you and I can recall a time when the S&P lagged.
Absolutely.
International for quite some time.
Right, 03 to 07 cycle in particular, the S&P lagged. And if we look at valuations, we look at yields, we look at currency impact and potential there. Global investing outside of the U.S. is sensible to to consider in the portfolio. And then finally, we've talked about alternatives, looking at, and it doesn't matter whether it's private market or daily liquid alternatives, but if you can find less to non-correlated strategies to stocks and bonds, it's sensible from a risk return perspective.
And that's where you need to have a team in place that has the ability to do the research, deep dive into those asset classes, and then also be able to execute at the right level.
The due diligence on that piece is really important.
Really critical. I always say too, even in up markets, you have some parts of your portfolio that just don't perform the way you want.
Right.
In down markets, it almost seems like they're a little bit more glaring.
Yeah,
but there are parts of your portfolio that still perform. The bond market just snapped back over the last 6 weeks. So,
very much so.
We have some bond bond parts of your portfolio that are doing just fine at the moment.
Right. That's right.
Just stay disciplined. I think
that's right. That's exactly right.
Thing. So, well, John, thanks. Anything else to add? Or are you feeling good?
Feeling good.
Let's go see what happens in 2023, huh?
I'm ready for it.
Well, for John McArthur, I'm Kent Skornia. I also want to say Happy Hanukkah to our friends out there. Merry Christmas and Happy Holidays to you all. Have a wonderful holiday season. Thank you.
Thank you.